Hello everyone, Glenn Downing here, Certified Financial Planner Professional at Cameron Downing, a registered investment advisory firm in Miami, Florida. This is one of a series of 3 Q&A videos, questions and answers. Well, it's about time I do these. The others have to do with insurance and financial planning. But today I'm answering investment-related questions, investment frequently asked questions. So let me launch in. Question: in what should I be invested? Tough one. Let me answer this with an illustration I give in my CFP classes. Say you're at a cocktail party and the most spectacular woman you've ever seen has just asked you what you do for a living. After you tell her, she asks you whether or not she should purchase XYZ stock. Here are your answer choices. A: well, let's do a risk tolerance survey and see if it fits for you. B: what other positions do you hold? How will this stock fit into your portfolio? C: are you investing for the long term? When will you need this money? Or D: may I get you another drink? And of course, D is the correct answer. There are steps to financial planning and investment management. We can make no recommendations for you before completing our due diligence. Only after we have a clear picture of your risk tolerance, your income needs, your tax situation, your time horizon, and cash flow position, do we make any investment recommendations. Here's an increasingly common question. Will you do socially responsible investing for me? The answer is yes, of course. There are several mutual fund companies that screen their underlying investments by various social and or religious criteria. So yes, that is certainly possible. Another question: how much do I need to retire? Well, best we can do is a projection for you. For example, say you want to retire 10 years from now. You want to have an income of $100,000 in today's dollars. You expect to earn an overall 8% rate of return. Inflation is anticipated to be 3.5% over that time. And you have a life expectancy of 30 years. Well, all of these are calculator inputs. If I put all that in my calculator and crunch the numbers, you'd want to have some $2.44 million in your investment account at retirement. But this isn't how real life works. Will your home be paid off, thereby reducing your income needs? Will there be an inheritance maybe? Do you want us to factor in Social Security into the equation, or will that just be a plus? Do you have rental property income, other business interests? All of these are considerations. Here's a good one. A TV advisor I like recommended growth index funds. What do you think? Well, so he does. But investing is not a one-size-fits-all proposition. Our recommendations are tailored to you and to your situation specifically. Question: are you a stockbroker? No. Cameron Downing is a registered investment advisory firm. As such, we are paid by our clients for advice. Our fee for that advice is taken, with the client's permission of course, from his or her investment account and calculated as a percentage of the assets under management. Our clients give us discretion to place trades on their behalf, and you should know that we never directly take custody of client assets. Instead, we use TD Ameritrade Institutional to hold our client investments. We are not active traders. I have no hot tips for you. We focus on long-term planning and invest for you to achieve your long-term goals. If you're looking for someone to actively trade your account, we're not going to be a good fit for you. Another question: what are ETFs? Exchange-traded funds. ETFs are generally investments that track an index. They are traded like stocks, meaning that they can be bought and sold at a market price during the day, during the trading day. The indices tracked by ETFs can be almost anything, including currencies, specific raw materials, and stock market indices, large cap growth, small cap value. A related question is, what are stop orders? Well, we use stop and stop limit orders in ETF and stock trading. These are sell orders that are in place now that become triggered if the security price trades below a certain dollar amount. The position will automatically be sold out. So we use stops extensively in our client accounts as protection against a large market drop or against market volatility. I love this one. Popular advertiser on TV hates annuities. Do you? Well, it would seem she does. Again, each investment product is designed for a specific purpose and situation. If the tool fits the job, then you use it. Annuities generally have two phases, an accumulation phase and a payout phase. During the accumulation, earnings can be fixed, variable, like as in from a mutual fund like subaccount, or indexed to one of the stock market indices. The plus is that they offer tax deferral during the accumulation phase. The minus is that income is taxed as gain over basis at ordinary income tax rates when you take it out. There's also no step up in basis at death. Still, for the self-employed individual, this is a way to purchase a pension. So back to the question. The investment product itself is neither bad nor good. It's just designed to do a job. The question is whether you're using it, the investment product, correctly. I've done a separate video on this topic, so have a look. Here's a question we get a couple times a year. I'm a foreign national who travels to Miami frequently. Can I open an account with you? Answer is sorry, but no. We don't take accounts for foreign nationals. Happy to refer you, though. Our choice here has to do with our own regulatory compliance reasons. We're just not geared up to do the necessary vetting and due diligence on someone who does not live here in the States. All right, next question is IRAs. Do you do IRA rollovers? Well, yes, of course. An IRA rollover means that you're moving money out of your qualified retirement plan at work due to some triggering event, usually your separation from service with that employer, perhaps retirement or just a new job. You do a tax-free rollover of the qualified plan balance to your individual retirement account. This should be undertaken with care, though, as employer-sponsored plans may have features not available in IRAs, specifically loan provisions, and also the availability of withdrawals at age 55 without a 10% penalty. Once you're separated from service, this is 4.5 years earlier than it would be from an IRA. A broad question, how should I invest my IRA? Well, that depends on you, on your goals, on your risk tolerance, on your time horizon in particular. The IRA itself is just a tax-deferred wrapper for whatever underlying investments it holds. This can be financial assets, stocks, bonds, mutual funds, ETFs, CDs, money market accounts. IRAs cannot hold life insurance. For those of you with children, is a good one. What are the options for college savings? Well, actually there are quite a few. First, you can simply invest in your child's name. The child owns the account. This may save you some taxes on the growth, but there may be what's called a kiddie tax involved for the child. There's a Uniform Transfers to Minors Act account, or UTMA. It's an account with a trustee. The assets are held in trust by a trustee for the benefit of the minor. At the age of majority, 21 in Florida, the minor has full access to the funds. These earnings may also trigger a kiddie tax issue. And then we have the 529 college savings plans, which are very popular. These are sponsored by the various states. They are of two natures, the prepaid tuition and the mutual fund investment type. Florida sponsors the prepaid tuition variety, but you can purchase any other state's 529 that you want. There are tax considerations in going out of state, but these are largely about state income tax issues, which, mercifully, we don't worry about here in the Sunshine State. You sign up for the prepaid tuition plan online during a specific offering period each year. Other states offer the mutual fund plans, which you can go into at any time. The big advantage to the 529 is taxation. There's a double tax advantage. You put money in on an after-tax basis, but it grows without taxation, first advantage. Then if it's used for qualified education expenses, it comes out of the plan with no taxation at all. Second big tax advantage, sort of like a Roth IRA. And finally, what tax considerations go into your investment recommendations? Well, taxes are a big factor, of course, in investing. What you get to keep after taxes is what really matters. Your investment earnings could be taxed at capital gains rates of 0% for those in the lowest brackets or 20% for those in the top 37% bracket, and 15% for everyone in the middle. All distributions from IRAs and from annuities are taxed at your ordinary income tax rate, not at your capital gains rate. Your need for income is a big part of it too. If, say, you want to retire at 55, income planning becomes crucial since you are below the 59 and a half age at which you can withdraw from your IRA without a 10% penalty. Taking into account your entire income tax situation is crucial in making any investment recommendation. That is why we request a copy of your recent tax returns. I could go on, but it's enough for now, I think. If you've got more specific questions, please email info@cameron-downing.com. As I began this video, please remember that there is a process to making investment recommendations, and that we cannot tell you what we think about this investment or that investment in a vacuum. Once again, I'm Glenn Downing, Certified Financial Planner Professional at Cameron Downing, a registered investment advisory firm. Please feel free to follow us on LinkedIn and other social media. Thanks for stopping by.